All right. We're starting to slow down on entries, so I'll keep admitting as we go, but I think we'll get started with our second webinar of the year. Today, I know this is one that, I see lots of familiar names on the webinar today. So thank you for joining. And this is a topic that we get asked about lots, which is to really break down this new structure, this employee ownership trust structure, and explain exactly how it works, who's eligible, what the process of transitioning is, and very importantly, to answer any questions that you all have. So we've got great speakers today that I'm excited to introduce to you. This comes off of our first webinar, which was in January, talking about different types of employee ownership. We can send out the link to that session if you missed it so that you can see the different types. And now we're really going to dive deep today into employee ownership trusts. This coming March, we're also going to be having a webinar specifically talking about financing employee ownership transitions and preparing for them, as well as valuing them, which we're very excited about. So to get us started, if we can flip to the next slide, I would love to just introduce our speakers for today. I am absolutely thrilled to introduce both Tiara and Elizabeth to you. I've had the pleasure and privilege of listening to both of them talk about employee ownership trusts in the past. Tiara is the CEO of Rewrite Capital Advisors. This is an M&A advisory company that specializes in employee ownership trusts transactions, which is what we're going to talk about today. She is also the board chair for Employee Ownership Canada and is one of Canada's foremost experts on employee ownership trust implementation. So really, really glad to have you with us today to teach us all about EOTs. Tiara is joined by Elizabeth Nolin, who is an experienced organizational development and change management professional. She has a master's in industrial and organizational psychology, and she brings a deep understanding of the human behavior in the workplace and how to drive effective people-centered change that benefits both individuals and organizations as a whole, so we can really set these transactions up for long-term success. And she is a great trusted partner in EOT transactions. So really great to have both of you with us today. And I'd love to turn it over to you so we can spend as much time as possible talking about EOTs. One quick thing before we get there, I do want to call out for all of our attendees that we'd love to get your questions. That's a really important part of these webinars. So if you do have any questions, you're welcome to add them to the chat and we can answer them as we go. And we'll also have time for Q&A at the end if you'd like. Okay, so I'll hand it over to you, Tiara, to get us started.
All right. Thank you, Justine, so much. We are always happy to be here. I love talking about EOTs with people who care about employee ownership. So this is literally my favorite forum to talk about it in. Elizabeth and I are going to cover a lot of ground with a lot of material because we want you to come away with a lot of value. So we'll have space at the end to have questions, but feel free to drop them in the chat. If for any reason they don't get answered here, we'll certainly take the time afterwards to answer them. I'm going to start with a very quick disclaimer just to indicate here that none of this is tax advice. So please don't go away and say, oh, I got the tax advice for this. And also you are free to use these slides if you want to, screenshot them or download them or anything, but please just keep the attribution on there that they're Rewrite Capital Advisor slides. Okay, so let's get into it. And the very first thing that I want to do is frame the conversation by talking about what are the defining features of an EOT, of a trust. So we have had all different forms of employee ownership in Canada for a long time before we had EOTs. We had worker cooperatives, we have ESOPs, there's a variety of ways that a person can do an employee-owned company. You can be an MBO, that's also an employee-owned company. But trusts are very particular legislation. Trusts have a few qualities that other employee ownership models do not have. So let's talk about what they are first so that the rest of the content makes sense. First, the ownership of the company is going to be by a trust, not an individual employee. What is a trust? A trust is a legal entity that divides the benefit of owning something from the responsibility of owning it. So employees are going to be the beneficiaries of a trust. They're going to benefit from the value of the shares that the trust holds. but it's actually trustees that are going to act with the responsibilities that shareholders have. And that makes this different from every other kind of employee ownership that we have in Canada. The trust means that employees become beneficiaries, but they don't hold all the responsibilities of shareholding. So that's the first major distinction. Second, because employees are not buying shares themselves, they're not bringing equity to the table to do it, which means that these transactions are 100% debt financed. Now, we'll talk a little bit about what that structure looks like, but the thing to remember here is the owner is going to get paid a fair amount for that company, but it's not the employees that are going to pay for it. It is going to be financed through debt over time. The third thing is that in order for you to have this kind of employee ownership, the EOT has to be the majority shareholder. It must hold more than 50% of the shares. That's a legislative requirement of an EOT. So that's a really important thing to know as well. In this form of employee ownership, it is broad-based, all-inclusive. All eligible employees must be beneficiaries of the trust. You can't pick and choose. You can't say this is just for my senior management team or this is just for a core set of people who've worked here for 10 years. If you do an EOT, all employees are going to be beneficiaries. Now, we can talk about that. There are other models you can do alongside. The EOT only has to hold 50% of the shares, so shares can also go to key senior members of your team. You have room to do that as well. But the EOT itself must include everyone that's an employee as a beneficiary. And the last thing, which is related to the first, is that employees do not have board voting rights or seats. So in a way, it's very different from a worker cooperative. People often think when we're talking about an EOT that we're talking about a worker cooperative model where everyone personally has a share, everyone has a vote, and everyone has the ability to have voice at the board. That's not how it works in an EOT. There is employee voice and there's employee representation, but it is not at the level of voting rights and board seats. So these are defining features that make the EOT different from other models. And we're going to go into talking about what that means in terms of the following things. We're going to talk a little bit about what does a transaction look like. We're going to talk quite a lot about what does governance look like? And we're also going to talk about the benefits to the employees and the sellers through this process. Okay, so the first thing that we'll talk about is the anatomy of an employee ownership transaction. If no one's bringing equity, what on earth does this look like? And one of the key concerns that people have is like, well, why would the owners give all their shares away to their employees? That is not what is happening. This is happening at a fair market price, so a full transaction price, but it is happening with debt. So let's talk about the structure, what that looks like. Okay, so before you have an EOT, you have a company, and the shares in this fictitious scenario are held 100% by one individual. In reality, it could be multiple sellers, but just to illustrate the example, we're going to imagine that a single individual owns all of the shares and they're going to sell them all over to an EOT. So the seller owns the company shares and they wish to sell those shares to an employee ownership trust. Now, how they're going to do that is they need to sell the stock to the EOT, and the employee owners are going to be the beneficiaries of that EOT. So the benefits of owning that stock will flow through to them. But the employee ownership trust itself is not coming with any cash, right? It is not an entity that has a bunch of cash. It's not an outside investor, and the employees are not putting up cash for those shares. And so then the question is, where does the cash come from? And really, it comes from two places. It's gonna come from the company in the future. And it's worth pointing out that the person who designed this structure, like in Canada, this is new, but the US has had their model for 50 years and the UK's had theirs for more than 10. The inventor of this in the US over 50 years ago was a bond lawyer who said, if I can issue debt that the company is going to repay into the future, why can't I do that for a transaction? And that's exactly what's happening here, is the company is going to use the engine of the company to pay the seller out over time. Now, typically, there are two ways which that's going to happen. So on day one, when the deal closes, you can have a senior lender, a bank, bring some cash to the deal. So you can put some debt on the company. The bank will give cash to the company. That cash will go through to the hands of the seller, and the seller will get a certain amount of payment at the transaction date. So whatever cash the seller is going to get, it's going to come from an outside lender lending to the company, and the seller will get that cash today. Whatever else is still owing to the seller, so let's say the bank can finance 50%. We see banks financing between 50 and 60% of the value of a transaction. So let's say the seller the senior lender brings 50% of the value of the company. The day that the seller sells to the EOT, they receive about 50% of the value in cash. And the other 50% is going to be an IOU from the seller to the company. So the company is basically saying, I can give you the cash we got from the bank today, and I'm going to have to give you the rest once we pay the bank out and over time. And that is like the basics of a structure for the EOT. First, the company will repay the bank, and then the company will repay the seller. And in that way, the seller comes away with the full value, and the company can be completely owned by the employee ownership trust, so by the employees. But you've used the economic engine and power of the company itself in order to make the transition happen. So that's the basic bare bones. Now, there's a lot deeper you could go, and you heard Justine say that we will be having another seminar in March. So if you're really interested to get deeply into the mechanics of fair market value, so how you assess the value for these transactions and what financial structuring can look like, then I highly encourage you to go to the March one. But this is just enough to give you a sense for the fact that these transactions do happen at the full value and full price of the company, and owners do get the cash for it. But what they have to do is they have to wait and get some of that over time. So it won't be all upfront. Okay, next what I want to do is I want to talk a little bit about eligibility. What kind of company can become an EOT? What are the constraints? And I should mention, there are two hurdles that a person needs to jump through if they're going to pass to become an EOT. The first one is your company eligible to be an EOT? And these ones, which I'll talk about first, these are the easy ones. The harder ones are, can you qualify for a capital gains tax exemption attached to selling your company shares to an EOT? And so I'll talk about it. There's a very significant capital gains tax exemption, but getting jumping through the hurdles to get the tax exemption is significantly more difficult than the hurdles for an EOT. So let's start with who can become an EOT. What kind of company? Sorry, the slides are moving very quickly today. There we go. All right, so really there are 5 things. If you talk to a lawyer, they'll say there's quite a bit more detail, but these are sort of the big 5 pieces that I would want you to think about if you're like, can my company qualify to be an EOT? The first thing is it needs to be a Canadian private corporation. So it has to be domiciled in Canada, controlled by Canadian directors, the definition for a CCPC. So if your company is Canadian, it operates in Canada, it's run by Canadians, and you have a CCPC, that's the first one, check, you can qualify. The second is you need to deal at arm's length with the EOT. So basically what's happening here is the transaction needs to be seen that you are selling to an EOT, which is a third party, i.e. not you or related to you in a meaningful way. So the EOT needs to show, and you need to show, that there is some independent due diligence and a fair market value taking place here. So what they're trying to prevent here in the legislation is that an owner says, well, I think my company's worth $100 million. And then they force a sale to the EOT and the company then has to pay $100 million for it, even if it wasn't worth that or no one else on the market would buy it at that price. So you have to prove that there's a process taking place here that means that the EOT is buying this at a fair value and that they're going to do their due diligence. They're going to look at the company to make sure you don't have a whole bunch of hidden liabilities or potential risks attached to that purchase, right? So dealing at arm's length is a really important part of this process. So when you go through it, you'll have to do that, and then you'll be able to prove that you qualify for that EOT transaction. 3, we've talked about this, and it'll come up several times. The EOT must own the controlling interest in the company. So it has to hold more than 50% at the transaction time and at all times thereafter. So that's the next one to check off. The 4th is that all employees need to be beneficiaries. So you can't carve this out for, say, 10 people or 15 people that you really want to reward. This is for all employees broad-based. That's the next one you have to check off. And the last one, which is a little bit harder, is you have to make sure that the majority of your business's assets are active. So it's something called the qualifying small business test. You have to have more than 50% of your assets are active assets. So if you're sitting on a pile of cash that you've been storing up that you don't need for something, it's not like for bonding requirements or letters of guarantee or credit, but you've just piled up cash because you haven't been dividending out, and more than 50% of your business is in these passive assets that are not related to the functioning of your company, you'll have a problem. So qualifying for that, you need to make sure in the 24 months prior that you have been an active business. And those are the criteria. Okay, The big splashy news, which I tend to bury the lead because I'm so excited about EOTs generally, but the splashy news about this is there's a huge capital gains tax exemption attached to this. And I'm going to tell you not only what it is, but why we have it. So to my knowledge, this is the largest capital gains tax exemption I think that the Department of Finance has ever created. And it's attached to creating an EOT. So if you sell the shares of your company into an EOT for the benefit of your employees, then you don't pay any capital gains tax on the first $10 million of that transaction. So if your company is worth more than that, say $15 million, and you sell $15 million into an EOT, then on the first 10 million, you'll pay no capital gains taxes at all. Now, this is not like your lifetime capital gains tax exemption. It must be happening at the moment, and I'll talk about that in a minute, the criteria for it. And you also can't defer it into other things. It's for this transaction only. So it's happening for this EOT. However, if you have two companies that operate completely separately, let's say you have a plumbing company over here that you own and an IT company over here, and they don't have anything to do with each other, if you sold one to an EOT and then another to an EOT, they both could get the EOT capital gains tax exemption. So this was created in 2024, and it was in effect for 2024, 2025, and it expires at the end of 2026. And Justine and the team at the EOC are working very hard right now because it is up for renewal in 2026, and we're asking for it to become permanent. Now, the reason why we have this, it's not a gift from the Department of Finance. It is attached to this policy here, and there are similar ones in the US and in the UK, because the seller, when they sell to an EOT, is not getting any equity from anyone, and they are often financing up to 50% of the transaction themselves. So they are waiting much longer for their cash. And so this $10 million capital gains tax exemption is intended to say, we understand that you are taking the patience and the risk to wait to be paid for the remainder, the balance of the transaction. And so you're going to pay less tax on it. That is why this incentive is so core to this legislation and why it exists. Okay, so remember I said jumping through the hurdles for the EOT was pretty easy, and jumping through the hurdles for the capital gains tax exemption was harder. These are the hurdles, and I want to tell you about them so that you have that high-level understanding of how they work. So first of all, this has to be your first EOT transaction for this company. So if you sold it to an EOT, you bought it back, and then you sold it to an EOT again, the second time it doesn't count. It's got to be the first time it becomes an EOT. The second is that there is a 24-month hold rule. This is very similar to your lifetime capital gains tax exemption. So personally, you have to have held those shares for 24 months before you can sell them. Now that is to prevent flipping, so that somebody comes in, buys a company, and 6 months later flips it to an EOT, and they get the capital gains tax exemption just for flipping. The government's trying to prevent that from happening. So you have to have held those shares for 24 months. We've talked about this one already. You have to meet that active asset test, so that one's still important. At the bottom here, this one was a curveball. We didn't see it coming. There's not a lot of explanation around why, but there are 6 kinds of professional corporations that are defined in the Income Tax Act that are excluded from the capital gains tax exemption. So if you are a doctor, a dentist, a lawyer, an accountant, a chiropractor, or a veterinarian, then you can do an EOT with your company, but you cannot qualify for the capital gains tax exemption. We don't know why. We're very sorry about it. The veterinary industry was deeply crushed when this happened because a lot of them were hoping to sell to an EOT instead of to private equity roll-ups. But unfortunately, that remains true. So yes, you can EOT if you're a corporation like that or a company like that, but you cannot get a capital gains tax exemption. Okay, on the other column, the buyer cannot be an EOT. So I want to talk about what this means in terms of a transaction because it's material. Let's go back to that idea that you have a company that's valued at $15 million and you only want to sell half of it right now, 51% to an EOT, which is totally fine, and you'll hold the equity for the rest. So you're going to sell about $7.5 million to the EOT on day one and hold the other. When you do that transaction, you will get capital gains tax exemption for the 7.5 million that you sell to the EOT. If later you want to sell the remaining 7.5 over to the EOT, you can, but you will not get a capital gains tax exemption because the buyer is already an EOT. And so that's material when you're thinking about how much you want to sell to an EOT. You want to try to make sure you get that 10 million into the EOT if your company is valued higher than that, to make sure that you are capturing the full value of the capital gains tax exemption. So other conditions, the seller cannot be a corporation or a trust. It has to be an individual selling the shares. Now, if you have a holdco, then you can sell the holdco to the EOT. So it's not necessarily a barrier. You'll want to talk to legal counsel on that. And if you have a family trust, that's also not a problem because family trusts were designed so that all the individual members of the family trust can have access to all the shares. So just before the transaction, you would roll the shares out of your family trust and be able to transact. So family trust is not a barrier to doing an EOT, okay? Other kinds of trusts would be, and if a corporation like private equity was trying to sell to an EOT, they wouldn't be able to access the capital gains tax exemption. The seller has to be the age of majority, and the seller or their spouse has to have had active participation in the last 24 months. Now, this again is to prevent people who are just passive investors. Somebody put some cash into a business, but they've never sat on the board, never participated, haven't really had any involvement. They don't get to benefit from the capital gains tax exemption. This is for hands-on operators. And the last one is that 75% of beneficiaries must be Canadian residents. So if you're selling to a company and it has more than that that are not Canadian residents, and this, by the way, is residents, not citizens. So even if someone's on their LMIA or they're here working, as long as they're resident in Canada, paying taxes in Canada, that checks the box. So that is a threshold at the time of the EOT creation for the purpose of the capital gains tax exemption. 75% of the employees have to be Canadian resident. So a few more hurdles to jump through to get this one. Okay, what we're going to do is I'm going to turn the floor over to Elizabeth. Elizabeth is our head of design and implementation at Rewrite. So she does a great job of taking clients in a very detailed way through the governance structures and the decisions that they need to make in order to be EOT ready. So Elizabeth, please go ahead.
Great. Thanks so much. I'm so excited to go through what we like to call the ABCs of EOT governance. It really breaks it down in a very manageable and understandable way. So today we're going to spend some time getting to know that. We're going to stress a couple of points multiple times. And if you leave today being like, I heard them say this 4 or 5 times and you remember it, then I'll be happy. So what we'll do is just start, just before we dive into the ABCs themselves, I just want to set the stage with some important framing. EOT governance, while it might seem intimidating or unfamiliar at first, is actually quite traditional. It operates with clear delineated roles between shareholders, the board, and executive management, which is the same structure that companies already have legally, even if in practice one person is wearing all 3 hats simultaneously. What the EOT governance structure does is make those distinctions explicit and provide clarity on decision-making at each level. Tiara said this earlier, but an EOT is not a worker cooperative where each employee has one vote on decisions in the business. Instead, it separates the responsibilities of governance from the benefits of ownership. So you have employees as beneficial owners of the business. So they're not directly involved in the governance day to day. There are a few specific circumstances in which they need to vote directly on issues where we call them pass-through votes because they pass through the trust to beneficiaries. And these are very specific, like a merger, amalgamation, or sale of the business, or any decision that would lead to 25% or more of the beneficiaries losing their status as beneficiaries. That essentially means, for example, if you have to do large layoffs, those are very specific instances. But everything else is really governed through these ABCs that we're gonna dive into in a little bit more detail now. So what I'll do is I'll spend a bit of time going through what the legislation says about the composition of each of the groups at each of the levels of the A, B, and C. And then we'll talk about their roles in a little bit more detail so we can really pull that apart and understand. So let's start, we'll just skip to the next slide there. So let's start at the highest level of governance, the level of ownership. We have our A in the ABCs, and this is the Assembly of Trustees. So as Tiara mentioned previously, we know that the trust must own the majority share of the company, so 50 plus 1%. But because the trust is not an individual, you need people to act on behalf of the beneficiaries. These are trustees. So the composition shown here, we like to give an example just for illustrative purposes. You do not need to have 3 trustees specifically. We do this to show you the proportions. You could have 1, you could have more. What is going to be best for your company is really something that we need to iron out during transaction to make sure that we're leveraging the strengths that already exist and maybe even filling some gaps in decision making in how you currently operate to make sure that your EOT is really set up for success. So at the Assembly of Trustees, the legislation indicates that a minimum of 1/3, so 33% of these individuals be employee beneficiaries themselves. This is on purpose. We don't want employee ownership in name only. This is where employees get their representation at the level of ownership. They have a real voice at that level. But again, they're not making these decisions on a regular basis for the entire group. They have their representative at the level of the trust. There's also a cap of 40% of the seats in the Assembly of Trustees for any previous shareholder. So this is anyone who held shares, doesn't matter if they held a majority, minority, and they sold to the trust, they are capped at 40% of the seats at the Assembly. This also applies to any of their related parties. So if they have spouses or children working in the business, they're absolutely allowed to continue working in the business. They're just all captured in that 40%. The reason we're doing this is if you take the typical scenario of a person owns 100%, sells that 100% to the EOT, this is a change of control. They can have a seat at the level of the trust to ensure continuity and stability, but you can't then have sold your company and then try to retain control at the level of ownership. That's why there's a cap there. So again, in our example, we've included 3 just to show you what the proportions would need to look like if you wanted to have seller representation at the trust. You have an employee there. We've left a blank seat. That could be another employee. You could have a professional trustee come in and sit within the trust. They could sit alongside as an advisor. I won't go through all of the different options that you have, but really what's right for your company is going to be decided during that design phase, during the transaction, to make sure it's leveraging your strengths. One of the biggest roles of the Assembly of Trustees is appointing or selecting the individuals who sit at the B, the board of directors, which is directly beneath it. What you'll notice here is that there's no requirement that employees be directors on the board. And so while some companies might in fact prefer that and like the mix of internal and external directors, it's not a requirement in the legislation. The only requirement for employee representation, again, is at the level of the trust. Here, you'll see, again, there's a cap of 40%, and this is for seats for being held for previous majority shareholders, again, and their related parties. So what your board of directors looks like, you could have 7, you could have 8. It really depends on your company and the proportions that will best suit your needs. And again, there's no requirement that you have employees sitting on the board of directors. And then the C in our ABCs is our C-suite. And we really like to illustrate this on this graph for 2 reasons. One, because you'll notice there's no percentages or caps or anything here. The legislation does not require you to change your executive management in your company in any way. And this is hugely attractive for a lot of business owners because what this means is your operation remains stable throughout the transaction. What's really changing is at the level of ownership and the board of directors. Everything else remains entirely the same within your company. The second thing that we like to highlight with this is you'll notice that the C-suite is highlighted in yellow here, similar to that employee trustee seat. And this is to remind you that while you can select, a frontline employee to sit within the trust, you can choose someone from your management team. They are all employees are beneficiaries of the company, and therefore you don't necessarily need to choose someone who's never had any experience with governance. And you, like I said, so many options you absolutely could, but you're not required to do that. The key takeaway here is that while there are some legislative guardrails, the EOT governance is so bespoke, so getting the right design from the start is really the foundation for a successful EOT. So let's talk a little bit about the role differentiation. You'll notice on the previous slide at the top where we had the Assembly of Trustees, we had a little box there for shareholders. And this again is the reminder that the trust must own the majority share, but that doesn't mean that it has to own 100% necessarily. You can have minority shareholders sitting alongside the trust. And so that can look like, you can do an MBO with an EOT, you can have different options. Some sellers may even choose to retain some shares and sit alongside. But this is really just to show that at the level of ownership, shareholders are not board directors, right? They're making decisions like approving bylaws and bylaw changes, but most importantly, they're selecting the individuals who sit at the level of the board. And again, when you think of employee voice and representation at the level of ownership, this is really where they're allowed to choose individuals who will lead the strategy of the company in a way that will benefit employees and beneficiaries in the long term. But the focus of the majority shareholder and the trustees who represent the trust and the minority shareholders is really about high-level ownership level decisions. Great. And again, we've talked about the Assembly of Trustees, but when we think about how shareholders might make decisions based on their own interests and the interests of the company, the trustees must specifically make decisions through the lens of what is in the best interest of beneficiaries. And that is part of their fiduciary duties. Beyond decision making, trustees also play a critical role in communication. So they're the employee representatives, but they're a key link in the feedback chain, both top down, and bottom up. They're stewards of the company's culture and long-term vision. And so in that way, they're making sure that they're selecting board directors who will carry that into the future. I want to talk briefly about the different steps in the transaction because there's a lot of different terms and we have the trust at one point, we don't have it at other points. So let's just talk about how the trustee's role can change throughout the steps of the transaction. So if we look at it like a timeline, before the transaction occurs and before the trust is formed, it's best practice to have someone called a trustee agent. So if you don't have a trust quite yet, you can't have trustees, which is why this person essentially acts as the buy side during the transaction. The trustee agent will ensure that the transaction is occurring at a fair market value. And this is really in the best interest of future beneficiaries, but it also protects the sellers because you have someone who can attest to the fact that due diligence was done and this was a very fair transaction. And so in that sense, it's really serving both future beneficiaries and sellers to EOTs. Typically, this individual is someone who's a professional trustee. They have maybe a legal background or legal counsel that they can draw upon, but their specialty is in the fiduciary duties of trustees. And so in step 2 here, a key part of the role of a trustee agent is to help prepare your assembly of trustees for their role once transaction has occurred. There's a bit of time while the transaction is happening that you can really use to your strength to set the foundation for strong governance and continuity throughout the transaction. And so incorporating your trustee agent into the training and preparation of your future trustees, and we typically say, employee trustees who may or may not have had experience with governance, but that there could also be seller trustees who've been wearing all 3 hats and are now learning how to differentiate and separate out their role. This is a very important part of the preparation that the trustee agent can have a huge impact on. And then post-transaction, once the trust is formed, you have your trustees stepping into their role. And so your trustee agent can shift into an advisory role. We recommend that they sit alongside the trust, providing mentorship and scaffolding for people's learning as they're getting used to their new role. That trustee agent can also take a seat within the trust, as we talked about a bit earlier, but really it's really up to what will best serve your organization and their governance to allow them to have smooth transition and stability throughout this process. We've been talking about board of directors, how they're different than trustees, but let's really drill this point home a little bit. The role of your board of directors is to set the strategy for the company. They select the CEO, they receive operational updates from management, they approve KPIs that management would like to plan for the year, and they make decisions through the lens of what's in the best interest of the company. Trustees, as we mentioned, shepherd the vision and the culture of the organization through the lens of what's in the best interest of beneficiaries. In practice, these 2 frames of reference are usually highly aligned, but clear communication between the trust and the board is essential to make sure that strategic decisions made by the board stay connected to the values embedded in the organization and protected by trustees in their role. One practical note that we like to flag here is during transaction, we actually recommend that the inaugural EOT board be appointed just before at closing. That way trustees, and if there are shareholders alongside, aren't trying to select directors at the exact moment that they're getting used to their own role, and that can be quite confusing. So we recommend, again, you set up your governance structure, appoint everyone ahead of time. That way they have time to learn and practice before heading into the practicality and operationalizing this structure that you've built once the transaction has occurred. All right, now I'll pass it back to Tiara to talk a little bit about how employees benefit from the EOT in general.
Thank you, Elizabeth. And hopefully now the picture is a little bit clearer for folks. You can sort of see how the mechanics are working. You've got these trustees, they're acting. Elizabeth's been talking a lot about what are the responsibilities, right, that the trustees hold. So now we're going to talk about one, the trustees hold the responsibilities, the employees have the benefits. So what does benefit look like in an EOT? So the first thing is that employees are going to benefit from the shares that are held by the trust. And there are really two ways that you can benefit financially from the shares in the trust. The first is profit distributions, and the second is equity. So how do they benefit from profit? Well, if the company has a good year and there are profits to distribute, then the company at the board's discretion will issue dividends, and whatever percent of dividends flow up to the shares in the EOT, they will flow right through the EOT to the employees. So the employees will actually receive dividends in the form of dividends. So when they're issuing, when they're paying their taxes to the CRA, they're paying taxes on dividends there, not income. And that's very simple. When employees are in the company and they're sharing in profits, they're benefiting from profits. If employees leave the company, then they're no longer sharing from distributions of profits. So very simple in and out for employees. The second is equity, and equity is more complex. But basically, if you imagine that the EOT holds, say, 50% of all the equity of the company, 50 plus a little bit, it has the ability to distribute that value to the employees. Now, I want to be clear here, the equity is never actually leaving the EOT, but the value of that equity, the monetary value attached to it, can be allocated to employees. So employees can earn portions of equity over time. Now, the way you design employees being able to earn that is very bespoke. There are not a lot of constraints on it in the Canadian model, but the most common way is that the longer an employee works there, every year they'll accrue just a little bit of shares, a little bit of shares, a little bit of shares, a little bit of shares. So as they work longer in the company, they're accruing a larger distribution of shares. So you're not taking the 50% of shares in the EOT and dividing it into a pie and allocating it to everyone. You're actually distributing it out slowly over time. And people, the longer they work there, the more they'll benefit from an increasing share position. And also, the bigger the company grows, the bigger that share position will be. When an employee decides to leave the company, then the EOT will be required to buy back the value of those shares that was allocated. So those are sort of the two main ways that these work. And you also can have, you can do either profit or equity or both. And you can do it for current employees and or former employees. So you actually can run multiple formulas inside of the trust, and they should be aligned with your values, your vision, and what it is that you are trying to reward. So lots of decision making to happen here, which is why it needs to be done thoughtfully. The question of how then do you distribute it? Okay, all my employees are in, we're doing very simple current employees, distributing only profits. How am I distributing it? Am I just cutting it all into equal slices and distributing it to all employees? Well, the answer is you could, but you don't have to. The government legislation requires that you must use one of the following three criteria, at least one, or any of the three in combination, but nothing outside of these. So you are limited to these three in whatever combination you want. The first one is total hours of employment service. That is, do you work full-time, half-time, 0.6? And that is really a proxy for equality. If you were to divide the profit distribution or the distributions to employees by just full-time employee, then you're pretty much saying if you work one full-time position, then that's one equal slice of a pie. If you work half of that, you get half of that slice of the pie. So that's your equality metric. The second is your total compensation. So that's how much you earn at the company vis-a-vis the whole company. And that's meant to be a proxy for responsibility. As you carry more responsibility in the company, then you often have a higher income. And the third one is total period of employment service, and that's really tenure. How long have you been at the company? So this one is rewarding loyalty or how long you've been at the company. And you can create your own formula using any combination of these things. So just a few rules. One is you can't be intentionally trying to increase your inequality. So like 3x times income, for example, would like give quite a bit larger distribution to your highest income earners vis-a-vis your smallest. So you can't do things like that. But otherwise, there are very few rules on this. And you can use these criteria to define a formula for profit or to define a formula for equity or both. And if you do both, you can do, those formulas can be separate. So lots and lots of choice here that we like to go. That's part of what we say. How you design this should very much be connected to the values that your company holds and the vision of what you are trying to create through this trust, right? There's enough choice in here. People will question why you made that choice. So you need to know why you did it. Okay, next, we're going to talk about how we become employee-owned. So what is the process of doing an EOT? Okay, so really we like to talk about it as two steps. You have pre-transaction, and then you have the transaction itself. And I would never recommend that somebody just jump into an EOT without doing some preparatory work to understand, because an EOT is large, complex, takes a fair amount of time, and so you want to make sure that you have a map for doing that first. So pre-transaction, we recommend the following steps. The first is a feasibility study. At the feasibility study level, the very first things you want to look at to understand, can I do an EOT, is really two critical areas. The first is, can your company sustain leverage? You are going to put debt on your company in order to be able to do this. And so you need to understand, can the company sustain that? Some companies can, in fact, many companies can. Some companies will struggle with that because they already have debt on the books or because they have very, very high capital expenditures. They're always buying equipment. That can make it harder to do this. So the first step is understanding what is going to be the financial impact on your company. Is it a smart and safe thing for you to do? And you also want to check about any key gaps. If somebody's been running this company for 15 or 20 years and they're suddenly going to step out of a CEO role into like a board role, who's going to hold the functions they've been holding on a day-to-day basis? That's the other thing that you really want to check for in this process. And those are both really common sense checks, but we'll do it with the math. We'll really take a close look at it. Once you know that you could do an EOT, the question is, should you do an EOT? And to answer that question, you need to kind of think through multiple scenarios. I like to say that EOTs are quite different from an M&A transaction, because in an M&A transaction, the seller is trying to maximize for price, so you're always pushing upward, and the buyer is always trying to maximize for return on investment, so they're pushing downward as much as they can. And that is the tension that creates the negotiation and the structure of a transaction in a third-party sale. But in an EOT, you don't have to maximize for either of those things, and the seller often has a lot of goodwill. They're looking for the continuity of the business. So you have a lot of choice here. You can do more bank financing or less bank financing. You can finance over a shorter period and have some more distributions for the company, retained earnings for the company or distributions to the employees, or you can compress the debt repayment and repay as aggressively as possible. There's no one way to do this. And the things that we need to consider when we're designing this are, how does the company fare? How does the seller fare? And how do the employee beneficiaries fare? And then also things like, what are the bank constraints that are attached to that? So we like to look at multiple ways, like 2, 3, 4 scenarios, really talk about what they mean for the company, the seller, the employees, before we settle on one that's the right one for the company. And all of that work should happen before you engage in a transaction, so you have a very clear understanding of what your transaction looks like. Now I'm going to cover just at a very high level, this transaction is very much like an M&A third-party transaction. The transaction itself, you're going to have to do all of the things in transaction. You're going to have legal, you're going to have due diligence. You have a third party who's reviewing all of that. They may have their legal counsel. So this looks like a proper mid-market M&A transaction. But in addition to that, you have these other steps that you need to do. The first is, you need to go through a process of design. You have to design what your governance will look like on the other side of this transaction, and also what your benefits will look like on the other side of this transaction. And at the end, you also need to think about, how am I going to implement this? And instead of talking about those components in more detail, I'm actually going to pass it over to Elizabeth, who runs this process for our team, and she can talk about that.
Yeah, so not to confuse you, even though we've broken it down as 3 steps in the previous slide, we've pulled it apart into 4, really to illustrate the difference between governance and benefits design. Typically that happens together, but what we want to do during that phase is really walk clients through a facilitated learning process about EOT governance. So take what we just went through in terms of the ABCs and multiply that and go through different examples. If people are going to be making decisions about what their governance will look like post EOT transaction, we need to make sure that they fully understand what the roles are before we can start deciding what the proper composition will look like. So it's very focused on learning and education. And then we move into a guided decision-making process where we stress test the different ideas, make sure that we've thought of unique scenarios that have already happened in the organization or are likely to happen, and really make sure that, again, there's no cookie cutter approach to designing EOT governance. What will resonate within each organization is within the hands of the people who are already there. And so our job is really just to make sure that it's fully understood, but that we're pulling out the right information to make sure that we are building something that will last for the long run. So once we've completed governance design, typically the same group of people will move into benefits design. And this is, what Tiara talked about earlier. There are many options for what your benefits distribution formulas can look like. The question is, what is your culture? And if we can move from a place of shared understanding of what your culture is and what you want to leverage, what works well and what will resonate, then we can really increase the certain behaviors within the workplace that we know are beneficial or that we know that people enjoy through the distribution formulas that we craft. And whether that be through profit distribution or equity distribution, we really talk about what the value is behind each of these decisions. And this is really tied into, the implementation part, which I'll talk about in just a second, but it's the idea that if we can educate people as to why we've made decisions, they're more likely to believe that those decisions are trustworthy and want to adopt them in the workplace later on. While this entire design process is happening, we have the transaction occurring. It's a very fulsome legal and financial transaction. So banks are solicited for different term sheets to make sure sellers are getting a great deal. Due diligence is conducted, and every piece of this is really project managed from start to finish to make sure that all of our deadlines are being hit and all of these different phases are coalescing together perfectly. And then, I could probably spend another hour just talking about implementation, because what we know about human beings is even if you have the best change that will benefit them in the long run, if you don't train them, you don't educate them, and you don't explain why, it's never going to land and it won't be adopted properly, which is not what we want when it comes to an EOT transaction. We've put a great deal of thought and effort into designing something that will work for this organization. And so we really set the tone for the change process that will continue happening post-transaction by focusing on the implementation work at the beginning. And so I mentioned previously the idea of training your trustees. That is a huge part of making sure that your governance is going to work well. But your trustees will also serve as change agents in your organization. These are people who will represent the change, who will educate their peers and colleagues, and who will really drive that change in behavior that we want to see through the EOT governance structure that we've just crafted. So really fostering that employee ownership mindset is so important, and how we set the tone for that based on training and education and crafting meaningful communication plans is a lot of the work that we do in the implementation process before transaction.
Okay, so this is a solution that can work for any company, but overwhelmingly, not just in Canada, but in the US and the UK, the companies that do this, they do it because they love what they've built and they're trying to protect it. That is the overwhelming core theme. They often have spent 25, 35, 40 years working with people that they love and they trust. And the idea of selling that to a third party where, they have, not only do they have no control and there's no cultural control, they can't even walk in the building, the day after the sale. It's not theirs anymore. They're completely separate from it. Is terrifying to a lot of people. And what happens to their employees after is also terrifying. So while this is a true change of control, the EOT will own the majority of the shares of the company. It is maximum cultural control and protection of that legacy through time. That is why we asked for it and why business owners love it in other parts of the world as well as in Canada. That's it at the moment. I want to pass it back to Justine. I know that people have been asking questions and we're happy to take them.
Great. Thank you, Tiara and Elizabeth. That was really helpful overview. We've got a bunch of questions in the chat. If anyone else has questions, please feel free to add those there, or you can also raise your hand and we can also have you ask them live if you would like. In terms of questions, one question that I got not in the chat, but privately was just how long do these take? So can you maybe just talk about what type of range you see in terms of the time that I need to get ready for a transaction like this?
Yeah, I would say we recommend it takes clients about 5 to 6 months to do this transaction if they're well organized. If you're doing this while you're also doing something else, like you're refreshing your enterprise risk management system, or you have a whole new vendor supply software or something, longer, because your team has to put in quite a bit of effort on this. But I would also say that's the transaction itself, and there's the learning curve before the transaction. So we can compress feasibility and road mapping into shorter, like maybe 2 or 3 months, but you want to do a transaction once you know what you're making, right? So I would say all in 9 months is probably what it takes for the process.
Great, thank you. Another question we have in the chat is, can I sell both of my companies to the same unique trust that would group together all employees? And if I do so, can I apply different rules to them? You talk about that.
Okay, so first I would say is if you have one EOT, then you have one set of rules and guidelines for beneficiaries. If you have multiple companies and you want to sell them into one EOT, I'm going to tell you that is when you need to talk to an expert tax lawyer, because there's the question of can you, and then there's also the question of like, is it tax safe and what are the risks attached to it? So one company into one EOT, very simple and safe. Multiple companies into an EOT, or one or related companies into multiple EOTs, more complicated, and you definitely want to talk to a tax lawyer about that. But if they're under one EOT, then they're going to have one set of benefits for all employees.
I'll also weigh in on that from my perspective. If you have two unique organizational cultures that operate in two separate companies, merging them into one, again, all the value drivers we were talking about during the design, it might not necessarily resonate. And so you wouldn't want to set up this new structure and then also deal with the convergence of two different unique cultures that are now under the same trust. It is entirely possible if they are related in some way, and I won't speak to specifics, but it is something that you'd also want to consider above and beyond the tax implications as well.
Thank you. I see one person has raised their hand. I'm going to come to you in a minute. I'm just going to take one other question from the chat. I realize I didn't explain how to raise your hand. So if you would like to ask a question live, if you go to React at the bottom of your screen, it will open a menu for you and you can click raise hand, and then we can come to you live to ask your question, make sure that we get the full essence of what you're after. There are a series of questions around how do you create a scheme where either you don't necessarily want to sell to 100% of your employees, or you want to sell less than 50% of shares. Maybe we did do a webinar, and we can send the link on different types of employee ownership, because there are other structures that may meet your needs. But could you maybe just speak a little bit to that, Tiara, and also talk about how hybrid models work? So that is something we spent a lot of time in the last webinar with Jennifer Williams talking about different structures. We have like an MBO and an EOT. Can you talk about maybe some of the popular forms and also how people end up transitioning to a partial or full EOT?
Yeah, I will. So first of all, let me say that EOT is part of a continuum of employee ownership solutions. It's designed for mid-market companies of a certain size, and really you can do it if you're smaller, but the sweet spot is that your company has become a little too expensive for your people to buy themselves, or you have quite a few people that you wish to include in that process, and some of them are lower income. So it's really good at including all employees and being able to handle acquisitions of companies that are too expensive for an individual. Like very, very common in construction, we'll see. I'm going to use construction as an example to answer this whole frame. Okay, imagine a construction company that's now got its valuation up past $20 million, and there's a handful of, let's say, 5 key managers on that team that really can run the company, and the rest of the guys, they put up buildings, they just build, right? And so this is a great way for folks who are just builders to become employees. So that might be a reason why you do it. It also might be that those 5 guys could never afford to buy a $25 million company. So that's also a sweet spot. Now, that doesn't mean that this has to be 100% EOT, right? So the requirement for an EOT is that you do have to have the majority, but you still have 49% of shares that you can allocate how you want. So you could do it, you could sell, 51% to the EOT, everybody's benefiting from that profit distributions only, but you could put equity in the hands of those 5 guys so that they're really focused on running that company super well and you know that they can do it. Or you might reserve some shares for yourself out of that 49, or you might put some in the hands of your kid if it's about continuing family legacy. So lots of flexibility in the 49%. We've actually seen EOTs that are profit sharing only alongside ESOPs, which are fairly broad based, up to 100 employees who hold shares outside of the EOT. So it's not the only way. But EOTs really are meant to be a succession solution because you're losing control, you're selling to lose control. If you want it to not be a succession solution, but an inclusion solution, then I would highly recommend you look at ESOPs, which is another offering that's offered. Like, you can get more information about those at the EOC, and Justine and the team can provide that for you. And that is a way that you can sell 10, 15, 20, 25, right up to 100% of shares, and employees buy them directly. And if you're worried about affordability, there are ways of structuring to, again, have some of the company engine be supporting that process. So putting some debt on the company. So this is not the only way. This is a succession solution that solves for a couple of things.
Great, thank you. Okay, let's move over to Nick. Thank you for your patience. If you want to take yourself off mute and ask your question, that would be great.
Yeah, thank you for the presentation. I'm just wondering about the trustee requirements. So you did a great job of answering a couple of my questions that I wrote down beforehand. One is the trustee's liability. So let's say that the company bought, the old owner exited for $5 million and the company took on debt of $5 million. Let's say things happen 3 years down the road, the companies can't pay for the debt financing. Is there any liability on the trustees for that?
No, to my understanding, no. That responsibility for performance of the company is at the level of board directors. They're the ones that have responsibility. And that's why there's directors liability insurance that people can get. The trustee's responsibility is the benefits that flow from the company. Are they being distributed fairly to the employees? Are what the employees want from that shareholding being represented? So no, they're not on the hook for company performance.
Okay, and I just have one more related to that. So I think, and can you provide an example maybe of operationally how a trustee would work, not in year 1, but as there's cadence, like year 2, year 3, just because I'm seeing a disconnect between how they can operate when they're separated from operations. So if they're not a member of the board, and would it make more sense for them to be a member of the board so they can do their role appropriately and not be a passive trustee?
Different roles. So when you say do their role appropriately, you're actually talking about controlling the strategic operation of the company. That is a board role, not a trustee role. There is a relationship, and we spend a lot of time on this in implementation. So Elizabeth can talk about it, but there is a relationship and some overlap in responsibility between trustees and the board. If everybody works together with open communication, the trustee's job is to make sure that value is being delivered to the beneficiaries, and the board's job is to make sure that they create value and protect the company. They have different jobs, but they need to talk to each other, right? We like to think about it like if you bought shares in Apple or Tesla, you would be able to benefit from the rise or fall of equity, benefit or lose, depending on which way it goes. You'd be able to benefit from distributions flowing to you, so dividends, but you don't have a right to tell the board what to do. But if you don't like what they're doing, then you can vote for board members that you think will do a better job. That's what the trustees have. But in a practical small situation, they're also the voice of the employees. So when you end up with very difficult relations between them, is when the board tends to shut them out or ask not to have them involved in anything. If the flow of communication is open, then you tend to have a very good working relationship. And trustees are often in frequent communication with the board, but they're not the board. Elizabeth, maybe you want to jump in and speak on this as well.
Yeah, I think it's about defining what your role is, right? So trustees, again, are not making board level decisions about strategy or operations or things like that. But when it comes to the times that we've seen, for example, in the UK, the instances in which trustees then retaliate and feel like, oh, I need to execute more power is when they are being frozen out from decisions and they're not being communicated with. So it's really about making sure that there is consultation, but it's the difference between, informing someone of a decision versus consulting them, right? Trustees don't necessarily need to be consulted, but they can be informed. And so if you set these standards ahead of time and make sure that there's clear communication, that way trustees aren't being frozen out of decisions to the point that the board is running off and making choices that they don't agree with and they feel they need to remove directors. If they're included in conversation, then they can just say, hey, this is what I'm hearing. I'm representing the best interest of beneficiaries. I'm also an employee. This is, an unpopular decision because culturally it's having an impact, or the long-term vision of the company is not being preserved. How can we adjust this? It's a conversation rather than an authoritative, no, we're not doing this. So, without getting into the nitty-gritty of examples, if you think about if a company were to do a strategic acquisition, for example, that is a board decision to determine whether or not it's a good call for the business to acquire another company. But if that company has a very different culture or some performance management issues with employees that could dilute the employee culture that you've built within your organization and potentially affect distributions because you're adding new employees, that might be something you would want to talk to your trustees about. They can't veto that decision if it is a good business choice. And that's where that frame of reference is coming from, right? It's board is doing what's in the best interest of the company. Trustees are doing what's in the best interest of the beneficiaries. But if there's a decision that the board has the absolute right to make and the trustees disagree with it, well, then when it comes time to, select new directors, if someone's term is up, that might play into their decision. So it's really about making sure that there's proactive communication to avoid conflict and or navigate conflict effectively if and when it does happen.
I'm going to just jump in here because we are a couple minutes over the hour, and I know some folks do have to drop. Tiara and Elizabeth, are you able to stay on for just a couple more questions so we can get a couple
Yep.
more answered?
Yep.
So those of you who do need to drop and haven't had your questions answered, please, you've got both Tiara and my emails at the bottom of the screen. Please reach out. There's also a number of resources on our website, including case studies of Canadian EOTs that you can take a look at if you would like. We're adding resources all of the time. So I just want to first thank everyone for joining. If you need to drop, please go ahead and do so. We want to be respectful of your time. And if you're able to stick around for another minute, I'm just going to go back to a couple of the questions that have been posted in the chat. And one I think is a really important one because we get asked it quite a lot, which is around the timing of liquidity. Like as an owner, how much money can I get on transaction day? What levers do I have to increase liquidity if I choose to? And just like, what is the timeline of repayment typically? Can you speak to that, please?
The timeline is super varied. So it's really going to depend on you. And that's, on your needs, on your preferences, on the team's preferences, and on the cash flow of the business. So let's talk about what that variation looks like, because that's really the closest that I can get. You can go out for the maximum amount of bank financing that you could get. Let's say it's 60% of the value of your company you could get from the bank. And we do see that. That's not uncommon, okay? So you get 60% of the value of the sale, like if you sell the whole thing today. So that's 60% of the cash in your pocket and 40% that you're waiting for. If you do that, you get the maximum cash payout today, but then you have to pay the bank first. So no more cash will really be coming to you until the bank is paid out. So you then have to wait. Maybe it takes 5-6 years, maybe longer for the bank to be paid out before you're being paid out the remaining 40%. And the truth is that once the bank has paid their loan down, if your company's been doing well, they'll probably come back in and pay out your second amount. So however long that bank financing is probably how long it'll take you to see the second tranche, which will then come to you when they come back in for another loan. But that's only one way to do it. Banks have a lot of constraints that will they want you to preserve cash in the company and make the company as strong as possible so that they have lower risk. So it's going to be harder for you to pull cash out if you're repaying the bank. The opposite of that is you go with no bank financing and you do 100% seller financing. Now you have maximum flexibility. We actually see you might actually be paid out considerably faster because the bank's asking you to retain cash in the business that you don't necessarily have to, you could pull more out to pay yourself out faster. So no cash payout on day one, but you could maybe be paid out in 3 or 4 years because you can get cash faster out of the business, and follow a good year, you can get more, right? With the bank, you wouldn't be able to do that. So seller financing, highly flexible, bank financing, highly rigid, but the bank is what gives you cash at day one. We usually see people, we go out to the banks and we say, what's the maximum you can do? And then we almost never advise that you do that. It puts more risk on the business. It puts a longer wait time on you. We usually say to people, what do you really need to get out at transaction? You know, whatever that number is for you, let's get bank financing for that. So we're often seeing 30 to 40% of transaction being bank finance. So you've got something now, but you can pay that out pretty fast at the bank. So maybe within 3 or 4 years, the banks had that paid back, and then you can get another tranche out. And at that time, you can have the same choice. Do you want bank financing or do you want seller financing? So those are the questions that we go through in the road mapping. There's no one right answer. It's got to fit your cash needs up front, your timeline overall, and what the company can handle with the bank and how much risk you want to put on the company. And then we find a way through that by talking to all those parties and figuring out what the best solution is. But ballpark, like 3 to 7 years, pretty common.
Thanks, Tiara. Rachel, do you want to ask your question live? I just want to make sure that we're catching it clearly. You're still on.
Yeah, sure. I can't seem to turn my camera, but yeah, no, I was just wondering, have you run into situations where employees don't want to join the trust and they feel like it's being imposed on them? Because I've come across this in discussions with people, and even when there's no apparent downside, some people may not want to be forced into joining the trust as an employee. So I was just wondering if that came into play either in the legislation when we, how did you come about to the decision that all employees have to be in the trust and that they can't opt out? And that's my understanding anyways. And also, like, how do you deal with that in terms of change management?
Yeah, great. Yeah, there is no opt-out. There is no downside. You're not on the hook for the company. Nothing gets clawed back. You're a beneficiary, not an owner. So there's no risk. You're literally getting something for nothing. And in Canada, I've never come across an employee that said, that's ridiculous, I'm out. But I did interview a company, one of the very first in the UK, that's full of like PhDs that work on climate related like forecasting, very, very, very complex academic stuff. And there was an American woman on this UK team that when they got their trust, she was like, this is terrible. This is preposterous. I can't believe that I'm included in this trust. And ultimately, she left the company a few months later. So the owner was like, I was completely mystified and I never could understand what she thought was the risk attached to it, but she was not into it. And the truth is, there isn't a way to opt out. What I will say to people, though, is there's plenty of room for indifference. Like, you just don't care. And at the end of the day, you get a bonus. It's like getting a bonus check for company performance. And I would say in the US, they say about 1/3 of employees in mid-sized companies don't really care. And that's fine, too. You don't have to. So, but yes, I have heard of it, but I think it's pretty rare.
To answer the end of that question about the change management part of it, I find often what we see when people are resistant to change, it's usually an expression of fear or misunderstanding. So again, if we're doing a good job of communicating how this works, how it's going to benefit people, or if it's just going to be something that's added that they don't really care about, typically we don't see a lot of people who react very negatively towards it, kind of saying, I don't want to be a part of it. And it is a decision that is being made at the level of ownership. It's a large organizational decision. Employees often don't really get to influence that. And if they take the time to do the learning and they're excited about the future of what that could be and that they will be able to feed back into certain decisions like that in the future, then that's great. But it's kind of like Tiara said, ultimately, people do have a choice to opt out by leaving the organization. And so while that's not what we want to see, that is their prerogative. But mostly if we're able to address the underlying fear, which usually comes from a misunderstanding of the process, people immediately, it's like a weight is lifted and they're like, oh, this is actually great and I'm very excited about it. So we haven't encountered that too much here.
Okay. Well, I think we're going to leave it there for today. I really appreciate everyone sticking with us for an extra 10 minutes and for all of the great questions. This has been a very informative session. So we really, really appreciate the time. Thank you both, Elizabeth and Tiara, for all of your expertise today. And if anyone has any other questions, please feel free to reach out so that we can get those answered for you. You can always find a number of resources on our site. We will be sending a quick survey out following this webinar so that we can continue to make sure that we're bringing you the content that will serve you best and will serve your clients best. So if you have any feedback, please take a minute to fill that out for us. We really, really appreciate it. And like I said, our next webinar coming up is all about valuing and financing these transactions. So we'll get into the money side of employee ownership transitions, and we're really excited to see you all in a month's time. So thank you all so much for joining us. Thank you again to our presenters, and hope you have a great day. Take care.